Advanced Financial Accounting. In this presentation, we will work a practice problem related to a consolidation where we have a parent-subsidiary relationship, the parent owning 100% of the subsidiary. We will be dealing with a situation where the fair market value will differ than the book from the book value for the property, plant, and equipment or depreciable assets. That's going to be our major focus. We will be doing the consolidation 5 years out. So in other words, we said that the consolidation or purchase took place in year one. We'll say 5 years out is when we're going to do this consolidation. That means we're going to have to deal with the depreciation expense and accumulated depreciation related to this difference between the fair value and the book value for that time period. We'll also have some intercompany transactions we will have to deal with as well. Get ready to account with Advanced Financial Accounting. Here we have our information where we have P purchased 100% of S on January 1st, 2000 X5. So that's going to be basically our year one, the beginning of the year. We're going to do the consolidation down here. It says as of 2000 X9, 5 years later. So if you count on the old fingers here, we got 2000 X5, 6, 7, 8, and 9. So we're going to be including, of course, the year in which the consolidation took place, considering it happened in January. Price, $215,000. Fair value of the property, plant, and equipment or depreciable assets were higher than the book value of the $56,000. So we're going to have to deal with that as we do our consolidation. As we deal with that, we will also be dealing with the related accumulated depreciation that's going to accumulate for 5 years that we're going to have to consolidate or deal with at the consolidation each time, because this $56,000 is not going to be recorded by S during their process because it's part of the consolidation. So that's going to be our major thing that we'll be focusing in on. We will also do our kind of consolidation between the building and the accumulated depreciation at the point of purchase. So we'll talk about that. That's where this $10,000 comes into play. In other words, the accumulated depreciation for S at the point in time that the purchase took place was $10,000. Then we have intercompany transactions, intercompany receivables. So I'm going to say that P has a receivable on the books from S, and then S has, of course, a payable on the books that goes to P that we'll have to deal with, the intercompany transaction. And the equity at the point of purchase was $56,000 and common stock $103,000. In other words, at the point of purchase 5 years ago, if we were to take a look at S here, assets minus liabilities equaling the equity section. Again, you can't take these numbers because this is 5 years later, but in practice, we would of course have the financial statements at the point in time the consolidation took place, as well as worksheets that would be going through this consolidation process if we had to do a consolidated financial statements each year. Assets minus liabilities at the point in time of purchase would equal the equity, and that's what we're going to be needing these numbers for. So the $56,000 and the $103,000. So then we have P and S here. These are going to be the financial statements or trial balances for the two companies, the parent and the subsidiary. They're separate books, just like usual. We will copy them across to the consolidation. We now have our consolidated numbers that are in balance. There's our net income at this point. Then we got to be considering our consolidation entries. Before the consolidation entries, however, we want to take a look at the Goodwill calculation. So whenever we do this, we're going to think, all right, I want to know this number right there, that $244,600. How is that being calculated? Typically, P will be using the equity method. So we want to think about the equity method. And then we also want to think about the differences that could have happened in the purchase from the book value. In other words, is it a wholly owned subsidiary as it is this time? Do we have any differences in the fair value and the book value at the point in time of purchase? Because we're basically going to have to account for those and adjust things to the fair value at the point of purchase. In our case, there was a difference, that being the $56,000. And is there any goodwill that will have to be taken into consideration? That's what this calculation will be showing us. We're going to start off with the book value of S, which is $159,000. Where did we get that? They had to give it to us here in our problem, 56 plus the 103. That's the retain or the equity section at the point in time that the purchase took place. In a book problem, they have to give us that because it's 5 years later. If it were in practice, we would actually have those statements. Note that if you were working a book problem and it was only 1 year later, then you might be able to get this information from the data that they gave, which would be the trial balance of S 1 year later, because you'd have the equity before anything closed out to it. But if you get anything after that, then they're going to have to provide you that information, because now it's 5 years later. And so we need to know what the equity was or what the book value was at the point in time of purchase. That's this information. Then we're going to add to it any changes from the fair value and the book value at the point in time of purchase. That difference being the $56,000 for the depreciable assets. In other words, we said that this building and the accumulated depreciation, not now, but 5 years ago when this thing was purchased, was $56,000 higher. The fair value was $56,000 higher than the book value at that point, which we're going to have to account for within our consolidation. Not only that, but we'll have to account for the depreciation and related accumulated depreciation related to it as well. That would give us a fair value of the $215,000. So if you think of these accounts that we then fair valued from a book value to a fair value at the point in time of the purchase 5 years ago, that comes out to $215,000. If there's nothing else involved, like goodwill, such as there is not here, because that's the amount we actually paid, $215,000, that's the amount that you would then pay. If there was some other intangible, such as goodwill, then the payment would still differ and you would have goodwill. In this case, we don't have goodwill. We paid the same amount as the fair value of the net assets. Our main focus here, again, focusing in on this difference and the effect, including the effect that's going to accumulate over 5 years related to the accumulated depreciation on that property, plant, and equipment. Let's now consider the investment in S. So this number here, how did that number get there? We're using the equity method. Now it's 5 years later, so all we're going to think about right now is the equity method for this current year. What happened in this current year with regards to the equity method? Now when we think about the equity method, you want to take a look at basically this account and this account and see if they're relatively what you would think them to be. So in other words, this is the net income, revenue minus expenses for S. P owns 100% of S. You would think under the equity method that P would be recording their percentage share, which in this case is 100% of S. That's not the case in this one. Why? And note that if it may be the case, you may have some problems where these two numbers are the same, and you just gotta know what happened or why this is happening so that you can account for that in your consolidation process. So in this case, S recorded their proper net income. This is right. But when they consolidate, P knows that they're going to have to deal with this $56,000 here and the current year depreciation related to it. So at the end of the day, after consolidation, P's not going to be really recognizing the $33,600. They're going to be recognizing the $33,600 minus the depreciation related to this $56,000 that they're going to have to increase. That's going to have depreciation on it at that time. So what's that going to be? If we pull out the trusty calculator, we're going to say, all right, trusty calculator, we've got the $56,000 divided by 10. Now that's a simplified calculation because it's 10-year property, but just note, in practice, obviously, we'd have multiple different depreciable assets. We'd need a depreciable asset subledger and calculate the added depreciation on all of it, but you get the idea. We're going to say it's another $5,600 in the current year. If we take that minus the income of $33,600, that's where we're getting that $28,000. So that $28,000 is they basically recorded the equity method and then accounted for the fact that there's added depreciation. So you want to take that into consideration. And then if we record this, then we're going to say there's a debit to the investment, the $33,600, credit to the income from S. That's for the net income. P owns 100% of it. Then we have the dividends at the $13,000. They all went to P because P owns 100% of S. Cash goes up for P. The investment goes up. Then we see the accounting for that depreciation. So this is P saying, and we're going to decrease the income by that $5,600, the depreciation for the current year, and then the investment in S. So here we have this and this and this add up to the $41,000. That doesn't, of course, add up to this $244,600 because these are only for the current year, 5 years later. If we were to go through that similar process over the entire 5 years, we can get to that $244,600. But this is basically the idea of what is happening each year. And there's nothing new. It's the normal equity method. However, this component is kind of new. So you got to take into consider, did the parent company do this last component, basically adjusting S's net income, considering changes to net income due to the consolidation, like depreciation expense. Okay, so now let's go through our consolidation process. So consolidation worksheet, notice we're going to get rid of this account. So that's the first thing I typically start with. As we go through here, however, note that you may do this with one long journal entry, or you may break it out into different kind of segments and components. I think in some cases it's actually easier to do the main component in one large journal entry, but I want to break it out and see it in multiple different ways. So in this time, I'm going to break this out into a couple different transactions and try to explain why. The more different ways that you can kind of put this together, the better you'll be able to understand it yourself, the better you'll be able to talk to someone else about it and see possibly what someone else is doing, right? So I'm going to say that the investment account needs to go off the books, but I'm going to want you to imagine that we didn't put this 216.6 here because that doesn't tie out to this 244.6. The 244.6 will have to come off the books, but I'm not going to do it yet. I'm going to just recognize that the plug is going to be this investment account, and I'm going to plug in whatever I need there based on after I remove the equity section. So then I'm going to go to the equity section, which is the other key component. I'm going to say, all right, here's the common stock. For S, I've got to remove that. So there's the calculation here. So there's the common stock for S. It's a credit. We're going to debit it then for the 103. So if we record that out, we got the 303 plus the 103 is the 406 minus the 103 gives us back to P, the 303. We're going to do the same for the retained earnings. It's a credit here. Therefore, we'll debit it in our journal entry. There's the 33600 plus the 93,000 plus the 423.6 minus the 93 S's portion gives us back to P's portion, the 33600. We're going to do the same for the dividends, except the dividends has a debit balance. Therefore, we will do the opposite thing to it, crediting it. So we got the 33,000 plus the 13,000 is the 46,000 minus the 13,000 gives us back to P's portion, the 33,000. Next, we're going to be dealing with, notice we basically removed the equity section here for S. That's what we did here. We're going to do the same thing, removing kind of the equity section down here, but typically we don't do that line by line because I want to see the detail. What we would typically do is decrease P's item here. And usually if P was 100% owner of S, this 28,000 would of course represent the 33.6 net income in S. But in this case, again, there's a difference because of that depreciation. So what we're going to do is we're going to take the entire amount of the 33.6, representing kind of the rest of the equity, which all of equity, right, includes the net income. So then we're going to say, all right, I'm going to take the 33.6. Now, that means that this account didn't do what I want. I know that should be 0 at the end of the day. And then I'm going to plug the difference into this account. In other words, the debits minus the credits here is now that 216.6. This is the plug of this journal entry. Debits minus the credits get us to that 213.6. So this did what we wanted in that it removed these accounts. That's what we wanted. And it basically reflected the 33.6, which is what we wanted. But it didn't do what we want here because this didn't go down to 0 and this didn't go down to 0. So that's going to be our first step then. Next step is we're going to say, all right, now I'm going to take a look at the depreciation because I know that this 5,600, this difference right here, we know that that's due to the depreciation calculation. And so I'm going to account for that. So I'm going to say, hey, look, in the current year, we calculated, and we did this last time. We saw when we did the depreciation on the added, I think it was 56,000 increase in the building and equipment resulted in the depreciation that would be added per year, this being 1 year, 5 years out, this year's depreciation would be 5,600. Now you would think that if you debit 5,600 depreciation expense for the current year, which isn't yet in the 33,600, you would credit then accumulated depreciation. And you could, or you can think about, I'm going to credit this amount to bring it back down to 0 to make that balance out. And then I'll calculate all the depreciation, accumulated depreciation for the 5-year period that's taken place. So I'm going to do that method here. And then the next problem that will work, we'll do it slightly different. And I'll just make this credit go to accumulated depreciation. You can see the different, some different workings on this. So then we're going to say depreciation expense is going to be debited. Now, again, it's been 5 years out, remember, since the purchase took place, but we're only recording 1 year of the depreciation because we're in the current year, the 5th year out. The credit's going to be going to the income in S, which will take this down to 0. That's what we wanted. So that goes down to 0. That's good. Then we're going to be dealing with the fact that we have to put the building and machinery on the books. So the building and machinery up top, you'll recall, was $56,000 higher. S isn't going to put that on the books. It's going to be a consolidation thing. We're going to have to do that every time. So we're going to say, all right, then the building and machinery is now $56,000 higher because we determined a fair value at the point in time of the purchase was $56,000 higher, which was 5 years ago. Then we have the accumulated depreciation related to it. This is something that we're going to have to adjust every year because, again, S isn't putting this on their books. So we have to put the cost on the books. The cost stays the same unless they sell it, right? And then we're going to have to deal with the accumulated depreciation that is going to be related to it. And it's been 5 years now. So it's been 5 years, including the current year. So in other words, I'm not going to record the normal depreciation expense, debit, and then credit accumulated. I'm just going to record all of the accumulated depreciation for the 5-year time period at this point in time. So if we pull out the trusty calculator here, then of course we have the 5600 times 5. That's going to be the 28,000. So there's the 28,000 accumulated depreciation for 5 years. Now the 56,000 minus the 28,000 is going to give us the investment of the 28,000. So 56 minus the 28 gives us the 28 here. That's what we have left in the investment, and that'll make it go down to 0. So we will then remove that account, and that's what we would expect to happen. Now this is your major consolidation. So these are the major consolidation entries that you want to be considering. You may think it's easier, and I think it's easier in some cases, to be honest, to just say that I'm going to take this down to 0 because that's where it needs to go at the end of the day. You'll see it's 0 at the end of the day. And then I'm going to remove all of these, right? I'm going to remove this, remove this, and then deal with the building and the accumulated depreciation and the depreciation expense all basically in one journal entry. I think it's almost easier to do that. But you can also see that it's easier to see here in some ways, or it's useful to see in some ways, that you have then this accounting for basically the equity section being removed, this then accounting for the current year depreciation expense, which is included already using the equity method in the income from S, this then representing putting on the difference in the fair value and the book value of the depreciable assets, the building and machinery, as well as the accumulated depreciation that took place over the 5-year period since the point in time that the purchase took place. Now note, when you look over here, you want to just have some accounts that you want to verify, right? So I'm going to go down, I'm going to say, well, I know that at the end of the day, whatever method you use, this account I know needs to go to 0. These accounts typically need to basically be removed to kind of go away. So in other words, these accounts you would think would go back to the parent account in this kind of type of problem. So these then matching these. So that could be a check figure. And this account, of course, needs to be removed. And one of the tricky components here will always be this depreciation. Is the depreciation recorded? Did P record the depreciation when they recorded the equity method in the income in S? And how's that going to affect the consolidation process? Now we're going to do the added couple things where we said there was an intercompany transaction. And these, I think, are fairly straightforward. So for example, if the accounts receivable for P, if we looked at the subledger and looked at it by customer, and we saw that S owes P, which we would find in the subledger, and then we looked at S's subledger for the accounts payable by vendor and see that one of the vendors is P, we should see an equal and opposite item there. We're going to say it's for $13,000, and then we would have to net them out, right? So assets would be overstated, liabilities overstated. We need to decrease both of them. So the accounts payable then, we're going to debit the accounts payable. So here we have it decreasing the accounts payable. Then the other side, the accounts receivable, we're going to credit or reduce the accounts receivable. Then we have the standard transaction related to the accumulated depreciation at the point in time of purchase 5 years ago. So if you imagine 5 years ago, we're looking at S, building and machinery, depreciable assets, and the accumulated depreciation. This number was 10,000. At the point of consolidation, we want to report it net as building and machinery up here, rather than having this number and then minus the accumulated just like we've seen in prior transactions. Therefore, we have to record this transaction here. Now note, we couldn't do anything tricky here that we've seen in prior problems where we basically said, we subtracted out the accumulated depreciation from the depreciation expense to find it, because it's 5 years out now. So we can't really back into it too much in an easy way like they might have you do in a book problem. In practice, of course, we would know that from the worksheets of the prior years and from the consolidation process. But they're going to have to give it to you if they make the problem go out more than 1 year, which we're basically doing here. Why? Because we want to focus in on that accumulated depreciation. All right, so then this standard journal entry is going to be the accumulated depreciation, then going down. The other side then going to the building and the machinery. So we've seen that before. So, and again, I would highly recommend that you would do a problem like this in Excel, because if you do this in Excel, like if you see an account like this that has multiple things going into it, you can then easily tie it back into your journal entries if you're using proper formulas, which we will use. Practice using proper formulas. If you set up your worksheet in a format like this, you can work through this way more efficiently. And obviously, the goal isn't to do it fast; it's to understand it. It's not only that you can do it efficiently, but you can check your work efficiently, move things around efficiently, check what is included in these calculations a lot more efficiently. Even here, I can't really see. I have to do a lot of work to kind of visualize what the journal entries are doing to the transactions over here. Whereas again in Excel, I could just double click on something or use a quick tool to see those connections and relationships. So I highly recommend practicing with Excel on these, both for accounting and for just learning Excel.